Right now, the market looks stable on the surface, but underneath, it is being supported by a few powerful forces that most investors don't fully see. When you understand these mechanisms, the economy suddenly makes a lot more sense. Our strategy approaches markets through probabilities and sequencing, not predictions, and that lens reveals why the system has not cracked, even while many people feel pressure. The first force is concentrated capital spending. A small group of mega-cap technology firms are deploying enormous amounts of money into artificial intelligence infrastructure. When only a handful of balance sheets drive a large share of investment demand, the index can appear healthy even if the broader economy is uneven. In other words, the market platform is being held up by a few massive pillars. This is not necessarily fragile today, but concentration always raises sensitivity. If the pace of spending slows or financing conditions change, the effect can ripple quickly across markets. The second force is the wealth effect. In the United States, a relatively small share of households drives a very large share of consumption. When asset prices rise, those households feel wealthier and spending often increases. That spending flows directly into economic activity and corporate revenues. The headline economy can therefore look strong even while many households are under pressure. This creates a split economy where the data can look resilient while underlying fragility quietly builds. The third force is psychological policy support. Markets often assume that if financial conditions deteriorate quickly enough, policymakers will soften their stance. Whether that assumption proves correct every time is less important than the belief itself. That belief can stabilize risk-taking and suppress volatility for long periods. It becomes a kind of invisible floor beneath markets until conditions eventually test it. When these three forces operate together, they create an environment where the system keeps moving forward even while stress accumulates beneath the surface. Concentrated capital spending supports growth, the wealth effect supports consumption, and policy expectations support risk appetite. None of these forces eliminate risk. They simply change the sequence in which risk appears. If this kind of mechanism-based analysis is useful to you, consider subscribing. The goal of this channel is to help you see the structural signals behind markets, so you can understand what is happening earlier and with more clarity. Now, here is where sequencing matters. When a few companies dominate earnings growth and market leadership, the index can stay stable, even while market breadth weakens. Historically, that combination often appears late in a cycle. It does not automatically signal an immediate downturn, but it does raise the probability of internal rotations, valuation pressure, and sharper volatility once conditions shift. Another element to watch is how credit conditions behave. Equity markets can remain calm for long periods as long as credit remains stable. When spreads widen or financing conditions tighten, that is often when the pressure beneath the surface becomes visible. Liquidity, credit, rates, and participation together tell the real story of market structure. At the moment, the most probable path is a continuation of a grinding rotational environment, where leadership shifts but the overall market structure remains intact. A secondary possibility is a transition into a more volatile phase where valuations compress and dispersion increases. A smaller probability remains that financial conditions tighten abruptly and trigger a faster repricing across risk assets. The important takeaway is that markets rarely move because of a single narrative. They move because of interacting mechanisms. Understanding those mechanisms helps us stay grounded in probabilities rather than reacting emotionally to headlines. Quick note before we finish. This content is educational and informational only and should not be considered financial advice. The discipline of watching signals rather than stories helps investors remain calm through noisy environments. When you focus on liquidity, credit, rates, and participation, the market structure becomes clearer. And that clarity is often the difference between reacting to events and understanding them.